Hello, welcome. This is smarthelping.com. I'm Jay, and this is the 10-year assisted living financial model. It's really a financial simulation. It's as complete as I could possibly make it. It has everything from acquisition and development costs to really dynamic depreciation assumptions, very dynamic revenue assumptions, staffing. We've also got a cap table, all the financial statements. We have an executive summary, cash flow waterfall, uh, because it's similar to a real estate model in some aspects because you're renting out rooms in a building that you've developed or purchased. But it's got a lot of other aspects of a regular startup, such as, very intense staffing costs, therapy, outsourced professionals, uh, in-house salaried professionals, nurses, LPNs, all that kind of thing. So I'll go through each tab here in the overview and I'll explain how it works. The first tab is global control. Here you can define the company name. This will flow to the financial statements. You can define the launch year. This will define when the model starts and all the dates that populate in the drop-down menus across the model. Launch date is just a formula. Exit month is when the model will stop. And then on that month, you can choose any stop month up to the 10-year time frame. And you could determine also if you want to include a terminal value on the end month or not. And then if you do, it'll do a 12-month trailing EBITDA valuation multiple. And then you'll get an exit value. There is very dynamic debt uh, assumptions. You can have an initial, essentially, acquisition or development loan, construction loan, where it's interest only, and then you've got some period and it could accrue or it could be paid monthly, and then it'll roll into a regular loan at the end of the term, whatever that's defined as, and then you can also have a refi, assumptions for a refi, and I'll go through all that. Finally, here, the main assumption left is when revenue starts. So this is to make it dynamic where, you're going to have some time where you're developing, where you're defining all these development costs and or acquisition, which we've got sections here. I'll go through this more in depth, but you have some amount of time that this is happening, and then once it's ready, you can define when you're accepting new customers to come in and start paying rent. So there's that, and then we've just got some assumptions on, if we're going to use a loan or not, yes or no, and then some percentage of the costs will be defined as coming from a regular loan. Then you've got total equity required for the project. So this is based on all startup costs and essentially total negative cash flows that happen. And then you've got the amount that's coming from investors versus owners, and this is driven from the cap table. These percentages here are the percentage of equity contributed by each in total and of this amount. And then this is the percentage received in distributions for each, which is defined on the cap table. There's also taxes, and this applies just to regular operating net income based on it, and that'll be on the income statement. I also did some capital gains taxes and some stuff in the exit month if you do include terminal value, and those taxes will flow through accordingly. Finally here, check summary. This is just to make sure all the different summaries we've built all match. These should always be 0. This is checking, balance sheet numbers, making sure the net income monthly and annual matches, monthly and annual detail match of cash flow, checking the balance sheet against the annual detail, executive summary to annual detail, distributions. So everything has to be 0, and that means there's no errors and everything's nice and copacetic. Okay, so that's the global control assumptions. We now have development and acquisition. Here you're going to go and define. So I did, let's see, 1, 2, 3, 4, 5, 6 sections here. And you can be very granular with these would basically be soft and hard costs that you have. Or if it's a purchase and acquisition, you can assign that separately here with all you've got, let's see, I did 22 slots for each section. That rolls up into a total cash outlay that happens. Um, so you can define these over time, development costs over time, and there's a bunch of different sections. I did the last one, which is land only, and again, land is not going to be depreciable. But if you see here, the depreciation on development acquisition, you can define the useful life of each section of costs, and it will then do the depreciation each month based on that. Now, if you do want to override this, you can manually input what you expect to depreciate in each month over the model, and it will flow through to the financial statements just fine. The only other aspect to this is you can determine on top of your EBITDA multiple valuation, if there's any other proceeds from selling anything of these items, you can put in here, and that amount will then offset against the value at exit to give you either a profit or loss, gain or loss, and um, that'll go straight to capital gains. So this is only to be proceeds from selling assets. This is not like uh, goodwill or anything else like that. That's determined elsewhere. Okay, revenue assumption. So here we get into the real meat and potatoes. This is probably where you will spend most of your time. So we have 5 different types of rooms. And so the way, I've researched and the way I found that billing and pricing works with these assisted living facilities is um, you have different room types, and then that has a base price, but then you've got an additional price that you charge based on the level of care for that room. And this is to try to match, revenues with costs. And um, these are just arbitrary numbers. You'll do research and put in your own numbers here. But you can see we've got room type 1, and we could define the total max amount of units of each tier of care for each room type. So this is saying for base room type, um, the first one, we're going to have tiers of care 1, where 12 rooms where the tier of care is tier 1. And then we've got 20 rooms of base room type 1, which is, I just put 2 beds, 1 bath. These could be all different types here. And then, so we're just saying the count of tiers of care for each room type. So here, tier 6, we have 1 room. Tier 5, we have 10. Tier 4, we have 55 for all 2 bed, 1 bath. So all these would be 2 bed, 1 bath at this tier of care, and this is the total monthly price they're paying. You can also define the occupancy and improvement in occupancy over time, as well as a stabilized occupancy. And that is granular and defined on a per room type basis for the tier of care. So like here, if we go to room type 2, you've got the count of rooms in room type 2 that are tier 1 tier of care. Then the count of room type 2 rooms that are tier 2 tier of care, and so on. And the base price of that room plus the add-on to the different tiers of care will apply down accordingly. And this is saying the tier of care add-on is the same for each tier 1 through 6 here in this case, and it just applies to the base price of each of these rooms to get to the total amount. So this is the total monthly price that's being rented out. That will be applied to the occupancy rate to figure out how much revenue is being collected. I've also got an ancillary income here for other services that the assisted living facility may offer and charge for, and you can define that per month in this box. You can also define the average annual room rate increase here, which will apply to this base amount and propagate. So this was the main, this is where you're going to spend a lot of time figuring out your assumptions for how revenue is created. Now you've also got staffing, and staffing's intense for assisted living facility. So you've got uh, in-house positions. So we've got 38 slots here. You could find the start month, the count, the starting monthly salary, and the benefits or payroll taxes, as well as the percentage increase in salaries versus percentage increase in outsourcing costs. And then that will show you the total monthly cost in each year based on those assumptions. You can see if we scroll down, we have more staffing positions that are in-house. These are RNs, LPN, STNA caregivers. The start month of each of those, their count, and the monthly salary, as well as their payroll taxes benefits. Then we have outsourced therapy. So this is like an assisted living facility usually will have some other company that they're paying to give them therapists. And so you'll pay a fee. We have it here where you'll pay a monthly fee for each therapist and the count, the start month of each slot here, the total count, and then this propagates over time based on the outsourcing increase in costs. Finally, there's outsourced professionals like doctor, audiologist, pediatrist, dentist, and these are similar start month, the count, and then the monthly fee paid to them. So those are staffing costs. You've also got other admin costs, utilities, legal fees, food costs, medical supplies, insurance, just general operating expenses that you're going to have, and you can define the monthly amount of those, the start month, and the annual expense increase of each of those. And that will propagate through the model. CapEx, this is pretty standard. I have this in all the models. It's just to account for things like equipment or anything you're going to buy. You can define when you're buying it, the amount, the useful life, and then it will that'll hit CapEx as an expenditure and also hit the income statement in depreciation. Cap table, here's where you're going to define where you're getting all the equity financing. So the total minimum equity required pops in here, which is based on total negative cash flows in the monthly periods. And you could define how much of the total shares that you're giving away, the amount, the percentage of each share type. If you have more than just common shares, I did up to 3 share types here. You could determine the contribution received from each individual investor or investor group. If you just want this to net out to the minimum, you can zero these out here and just have it all flow to overflow, which is just going to take the minimum equity required, less any funds contributed from outside investors and inside investors. So you just define the common stock, share, pref class A, pref class B, and that will go over here. And this is the main percentage that's used. And then we can see the monthly cash in and out for each individual, as well as their IRR, which is taking the month, it's doing an IRR on a monthly basis and converting that to an annual rate. And this goes out for the full 10 years for each entity. And then down here, same deals, but it's just insiders. You can define their contributions and then the share of the profits that they get. So cap table, we have terminal value. This is just taking that EBITDA amount 12 month trailing from the end month, times it by the multiple. You get the total exit value on that. You can define how much of it's going to be applied to the fixed assets on the CapEx schedule versus how much goes to extraordinary income, and that's just going to be a tax thing. If you're not going to have taxes as an display, or you want to zero it out, then you would just put 100% for this and zero out the taxes here on the global control tab. Startup costs, just other costs that aren't included in the template anywhere else. So this is like maybe initial legal fees, anything you have to do that you're not really going to put on the monthly cost schedule, but it is a cost that you want to account for. And then debt schedule, this is pretty advanced, but what it does is any negative monthly cash flow, it will take a percentage of that based on the percentage defined here and essentially act as a draw, and then you're paying interest on this debt over time, and you can choose to accrue it or not. If you do accrue it, then you're not actually making payments until the interest only period ends, and then that rolls to a regular P&I schedule where you do start paying principal and interest. Just a couple notes on this. You want to make sure the date here, the start month of the loan, matches with your first draw month, whatever that might be, and it might not be month one. If your model could start in 2023, but you might not have draws till April or May. So just make sure this month number lines up with the first draw month. Interest only period, that'll define how long interest is being charged for on the ending balance each month, and then and then you can also define the max amount of months to draw from. So this is basically saying it allows for potential burn to not be financed. If this is only a construction loan, then you can define, well, I only want to finance up to month X, whatever that might be, and then any negative cash flows after that will not flow into here. So this is kind of a helper input to give the user more option for what negative cash flows are actually flowing into here. And this is pulling right from the monthly detail, which this aggregates everything we just kind of went over, all the way down to EBITDA, debt service. Um, it's this row is where it's pulling from, which is all cash flow after or before financing. And then you can find the terms of the traditional loan here if you're going to take on debt, interest rate, term, any prepayment penalty fees if you do refi. And then you have a potential for refi. If yes, it'll flow here on whatever the refi month is. And you can find those terms as well as the EBITDA multiple and LTV basis for what that loan amount equals. And then that amount will be used to pay off the previous loan, and then you'll pay P&I on this. Now this is more of a real estate structure, but since the the assisted living facility is kind of a hybrid between a real just a traditional like a multifamily building or some building you're renting out, but it has a lot of other things that are more traditional to running a regular business that's not specific to real estate, so it's a hybrid. But I thought this was the best way to structure things. So you can do a possibility for refi here. If you hit no, it'll just zero out and everything will be in this loan, the original loan. Benefits, this is just a matrix to figure out payroll taxes and benefits charged to all of the salaried positions based on those percentages defined on the staffing schedule. Then we have our income statement. You've got rental revenue, other ancillary income. There's no cost of goods sold. You've got then other operating costs, which is staff, outsourcing staff, other selling general and administrative, and the startup costs. Then we get EBITDA. We have interest, depreciation. So this is depreciation from the first CapEx schedule, and then this is depreciation from all of the acquisition building costs section. Then you've got extraordinary income, net gain or loss from sale of assets, taxable income, income taxes, and net income. And you can see on the exit month, these flow in, and then you'll see those taxes hit on that month for the exit if you're going to include a tax rate on that. If not, again, you could zero it out, and then there would just be no taxes. Now, if we keep going here, income statement annual is the same deal, but just on an annual basis. Balance sheet shows your cash, the value of the fixed assets, accumulated depreciation, total asset value, debt, owner equity, retained earnings, and then owner's equity, liability plus owner's equity, and then a check to make sure the accounting equation, obviously assets always equal liability plus owner's equity. So you can see that over time. Balance sheet annual, same deal, but on an annual basis, and this all checks out. You got cash flow statement, so we've got operating activities, investing activities, and financing activities, and the total resulting cash flow from each. And you can see these are zero because we're saying that we're only we're contributing just enough equity to keep the cash above zero, and that's what the model essentially solves for. Cash flow statement annual shows everything cash flow activities on an annual basis. Distributions, this is the discounted cash flow analysis. So this is the project level right up here. You can see the internal rate of return. If you apply discount rate to the future cash flows, you get a net present value right here based on the discount rate. Also, same thing for the investors. Their contributions, their internal rate of return, and then discount rate and their net present value, and the same for owners. And you can always tell the IRR is correct if you copy this and paste it into the discount rate. It'll make the NPV 0. So you do that and you can see it is 0. There is a bit of math going on here to convert monthly period cash flows to get the proper internal rate of return. So it's a bit of an advanced formula there, but it's not that complicated, and it is all correct there as you see the check to 0 NPV. There's also a chart down here to show cash flow for investors and owners each period. Visualizations, I did annual revenue by type, annual EBITDA, and actually this is not by type, just annual EBITDA, annual revenue versus expenses over time, annual cash flow versus cumulative, balance sheet cash by month, assets, liabilities, owner's equity, values over time, EBITDA versus debt service and ratio. So this is a very important one, debt service coverage. Here, my assumptions are just arbitrary, but here it's saying, by 2026, we're actually have more debt service than operational cash flow. So that is obviously an issue. You'd have to adjust assumptions to improve that. Annual revenue by room type, weighted average occupancy by room type, and then finally weighted average occupancy for all rooms of the whole facility over time. So those are the visuals. Executive summary here is just showing you a high-level look at all items: revenue, gross profit, expenses, EBITDA here, and then all the other cash flow items, taxes, capex, debt service, startup costs, proceeds from the exit, and this cash position will check out with all the other summaries. Let me see. Oh, and actually, so here, I want to go back to this. The debt service coverage, this is actually positive debt service. We have our zero balance for the money on this line, but we have the zero line for debt service ratio here. So this is actually, this line chart is a little bit of a different axis. So this is still positive. Your EBITDA is higher than the debt service, just to be clear here. It's a little bit confusing because this line is below, but it's on a different axis. So below zero, debt service coverage would be aligned with these gold diamonds that is below this. Okay, so that you've got a summary for equity multiple, ROI, and IRR for project investor owner here. You've also got total revenue and EBITDA again in this chart. Now the monthly detail is showing you all of the different things. This is basically the aggregation of all the assumptions on a monthly basis. Over time, through the full 10 years, and we go down, we get to EBITDA, we have other cash flow items, our financing, all the debt logic, cash flow after debt service, and then final cash flow after taxes and exit proceeds. Annual detail, same thing, but on an annual basis. And you can hide these if you want to roll up to see just high-level items. You can minimize. I group these so it's easier to see, so you can just, scroll easier. Okay, and then, finally, let me not forget the optional cash flow waterfall. So this is if you want a more advanced distribution schedule, and all this is essentially replacing what you see here on the 41.5% and 58% distribution rate for investors versus owners. Instead, what this schedule does is it looks at all the contributions of the whole project, and then based on the amount of contributions from the LP and GP, you've got that flowing in here, and then up until a given IRR that's been achieved by the LP, cash is split one, at this rate. So this is what replaces that static percentage, and then up to 11% IRR, the LP gets 80%, and then as it gets better, the LP will give up more cash flows because they're getting a higher rate of return. And what this incentive structure does is it basically is saying, okay, the LP is saying to the GP, if you give me better returns, I'm willing to give you more of the total cash flow over time. So that's what this allows you to see. And then this is a monthly basis. You can see the IRR has been converted to annual with the XIRR function. You've also got equity multiple here, and then a discounted cash flow analysis for each sponsor and investor cash flows on the aggregate pool. And in this case, we finally get to the last tier on month 90. You can see how this flows. There's a little bit here, and then we go up, 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 get to thereafter um, on this cash distribution month. So this is all dynamic. It'll change based on all of the assumptions and the cash in and out over time. And then there are checks on this to make sure this matches up, as well as these totals here that are total cash that's going to sponsors versus investors will match up with the annual ending cash flow here, this one. And that check is one of the last ones we did right here. It is the last one we did. So this allows you to feel confident that the model hasn't broken itself and everything's flowing nicely if all these are 0. Okay, well that's all I got for you. You can purchase a template below. It'll be in the description of the um, video, and I'll also put it on the vendor sites. The one-time price to buy it is $75. I think that's very fair for all the value you're getting here, and I'll see you on the next one.